The Lord of Easy Money. How the Federal Reserve Broke the American Economy by Christopher Leonard offers a compelling analysis of the Federal Reserve's monetary policies over the last few decades. Leonard argues that these policies, particularly quantitative easing, have contributed to growing inequality, financial instability, and an unsustainable economic system. Below is a detailed summary of the book's most important topics. Leonard explains the central role of the Federal Reserve in controlling the nation's money supply, setting interest rates, and guiding monetary policy. He emphasizes how the Fed's actions, especially since the 2008 financial crisis, have significantly influenced wealth distribution and market behavior. Key takeaways. The Fed's dual mandate is to ensure stable prices and full employment, but its policies often disproportionately benefit the wealthy. Through tools like quantitative easing and near-zero interest rates, the Fed has injected trillions into the financial system, inflating asset prices but doing little to help the middle and working classes. Leonard delves into the origins and mechanics of quantitative easing, a monetary policy where the Fed buys government bonds and other securities to inject liquidity into the economy. This policy became a cornerstone of the Fed's strategy during and after the 2008 crisis. Key points. Quantitative easing was intended to stabilize the economy by encouraging borrowing and investment. It led to significant asset inflation, benefiting those who own stocks, bonds, and real estate while leaving wage earners behind. Leonard critiques how quantitative easing became a long-term policy rather than a temporary emergency measure, exacerbating wealth inequality. The book highlights how the Fed's policies disproportionately benefit the financial elite, a phenomenon Leonard ties to the Cantillon effect, the idea that those closest to the source of newly created money benefit the most. Examples. Ultra-low interest rates made it easier for corporations and wealthy individuals to borrow cheaply, fueling stock buybacks and mergers, rather than productive investments. Ordinary Americans, by contrast, saw stagnant wages and rising costs of living, as quantitative easing did little to address systemic issues like job creation and affordable housing. Leonard provides a detailed portrait of Thomas Honig, former president of the Kansas City Federal Reserve Bank, as a key figure in the book. Honig emerges as a contrarian voice within the Fed, warning against prolonged easy money policies. He cautioned that quantitative easing and low interest rates would create bubbles in financial markets. Honig advocated for a more balanced approach, prioritizing sustainable economic growth over short-term market gains. Leonard examines how the Fed's policies have encouraged excessive risk-taking and created a dependency on easy money in financial markets. Investors have been pushed into riskier assets in search of higher returns, inflating bubbles in areas like technology stocks and cryptocurrency. The Fed's interventions have distorted market signals, making it harder to assess the true health of the economy. The book connects the Fed's policies to broader societal issues, arguing that they have widened the gap between the wealthy and the rest of society. These policies have reduced the purchasing power of ordinary Americans and made the economy more fragile by increasing debt levels across households, corporations, and the government. Leonard concludes with a call for reform, suggesting that the Fed needs to reassess its reliance on quantitative easing and low interest rates. He argues that the Fed should focus more on policies that benefit the broader population, such as wage growth and job creation. Additionally, improving transparency and accountability is crucial to ensure its policies do not disproportionately benefit the financial elite. Final thoughts. Leonard's The Lords of Easy Money provides a critical look at the Fed's policies and their long-term consequences. It argues that while these policies were introduced to stabilize the economy, they have inadvertently fueled inequality and financial instability. By weaving together economic theory, historical analysis, and personal narratives like Honig's, Leonard paints a vivid picture of how the Fed's decisions shape the lives of ordinary Americans and the global economy. This book is essential reading for anyone interested in understanding the hidden mechanisms of modern finance and their profound implications for society.